I think it really has been incredible times. And what I would say is we at KKR have been long-term investors, and we've invested through a number of different cycles. And no cycle is the same, and this is definitely a different cycle. But I think that the key from our perspective has always been to stay calm through these situations. Exactly. And actually, in times of volatility, you tend to find some pretty interesting opportunities to invest behind. But I think the most important perspective from our view is that volatility is now going to be a persistent feature of the market. And actually what we're navigating is very different to the last crisis. So if you think about COVID, we were navigating through a global shutdown where actually no one really understood what was going to happen during that period. This is a very different cycle, a very different volatility. We're really now, from our perspective, we are adjusting to a global risk recalibration. And so that's what you're still seeing in the markets. And once you saw the bond markets, go to levels that we haven't seen since 1982, actually the credit markets held up really well. So if you look at what happened with spreads during that peak, like US IG, for example, went to 118, but in 2022 they went to 171.
Why do you think that is?
Ultimately, the backdrop is very different today. Like, we are in a fundamentally stronger position than we were back 5 or 6 years ago. Tariffs also don't affect every sector. And there's also a huge amount of cash sitting in money market funds and an incredible amount of dry powder. So our view is you're seeing investors actually prepared to come into the market. And even during that volatility, we use that as a time to rotate our public credit portfolios, both globally and in Asia. And we also use that opportunity on the private credit side to be talking to corporates. We were talking to them pre all the announcements. They needed capital. They need flexible capital. Those conversations just continue to become more important.
Many are talking about asking these questions in the media. That is private credit peaking because it's just taken off so much in the United States. But some were saying, nuh-uh, Asia didn't really get there yet. So we are still looking at some opportunities. And that was really the setup going into KKR because it's your exposure to Asia private credit is still below, given the size of it, below the US and Europe. Are you feeling like this is really the opportune time to make your presence?
So I've been in the Asia credit markets 20 years. And actually, Sherry, I would say this is the most excited I've ever been. And I would say that's for a couple of reasons. There are 3 fundamental things that have happened in the market in Asia that are driving the growth and demand. So the first one is banks and commercial banks dominate lending in Asia. They're around 80%. And what we're seeing with those banks is they continue to have very conservative lending standards, particularly in times of volatility. So they're struggling to really step up and provide the capital that's needed in Asia. The other thing that's interesting with the banks is actually we're having a number of conversations with them about how do we partner with them, because they also don't have enough capital to grow. And so they're seeing private credit as an interesting partner. Point 2 is the Asia growth and the tailwinds in Asia, which really are not totally changed or affected by the tariffs. Those tailwinds are driving an enormous amount of discussions we're having with high-quality scale companies for flexible capital. And thirdly, I think you've seen the private equity industry grow significantly. And they've been active users of private credit in the US and in Europe. We are now seeing them more keen to work with people like ourselves on having flexible capital. And whilst that's usually considered for M&A, actually we're having a number of discussions with them now on optimising their portfolios to enable them to give capital back whilst they can hold the assets for a bit longer and sell them at the best time. So all of that has really led to why we've been able to do 60 transactions. And the other thing I would also note is, like, to your point, less than 5% of all capital has been raised for private credit. So you've got a huge amount of demand and very little flexible capital today. So that's what's really driving the large supply and demand gap.